Open your UPI app for a second. Ever wondered who keeps your tap safe? Today, we're mapping the safety architecture of your money. RBI, SEBI, IRDAI, PFRDA. What do they do? What responsibilities do they have? And why coordination matters when things get shaky. At the top is the Reserve Bank of India. It's not just the issuer of your currency, it's the guardian of financial economy. When the demand is high, it increases the repo rates to cool down the demand and tame the inflation. And in stress, like pandemic, it ensures that the rates are slashed and moratorium is available to the borrowers and banks so that they don't break the chain. It maintains the flow of liquidity and it nudges banks towards responsible lending. It is the pulse of this financial system. Just to cite an example, RBI raises repo rates, bank hikes loan rates because of that, and your EMI increases. When it wants to cool down the inflation, it cuts the rate, which results in your EMI in easing. That's one way in how RBI is impacting everyday lives. SEBI is the watchdog of India's capital markets. It protects the investors, supervises brokers and mutual funds, and enforces governance and clean disclosures. If there is insider trading or governance lapses, SEBI investigates, penalizes, and forces corrections. Its job is simple to listen to but hard to do. It wants to keep the market fair so that the prices reflect reality and not manipulation. To cite an example of how SEBI keeps the market fair, when a company goes for an IPO, it must disclose its use of funds, the risks that are involved with the company, and its promoter holdings, so that the investors are not getting into a mystery box. IRDAI protects the insurance so that your policy isn't just paper. It sets the solvency margins, which are buffers that make sure that your claims can be paid even in extreme years. From product rules to conduct standards, its focus is to ensure that the policyholders stay protected, especially when they need it the most. PFRDA safeguards long-term investments through the national pension system. That means transparent processes, regulated fund managers, and controls designed for decades, not just months. Banks, NBFCs, market, pensions, insurance, no single body can oversee them all, but they are all interlinked. An issue in one corner can lead to increase in funding costs, dampening of market confidence, or an impact on household savings. So the multiple regulators come together to ensure stability, resilience, and fairness. If India's financial system is a fast-moving train of growth and innovation, the regulators are its tracks and its signal. It ensures that the system is on track, on course, and on time. In the next episode, we will move from what the regulators do to how the risks are measured, delving into operational market and credit risk with real-life examples.